started with something that wasn't supposed to happen. Not a crash, not a bank going under, not a war headline, a vote. Behind a closed door in Washington, inside a building that has controlled the cost of money for more than a century, the people who are paid to agree finally did something they almost never do. They disagreed. The most powerful central bankers in the world walked into a room, looked at the same data, the same charts, the same debt numbers, the same inflation reports, and came to completely different conclusions about what happens next. Some wanted to cut, some wanted to hold, some quietly wanted to hike. On paper, the Fed held rates steady. That's the headline. That's what the crawler on financial TV repeats every 20 seconds like a lullaby. But under the surface, something snapped. The level of open dissent inside the Federal Reserve just jumped to the highest point in more than 30 years. The last time it looked like this, the system was still digesting the Volcker shock in the early 90s recession. Back then, rates were high because inflation had only recently been beaten into submission. Today, rates are high because inflation came back from the dead and the debt pile is orders of magnitude larger. The combination is not a policy debate, it's a fuse. And tonight I'm going to show you why the most divided Fed in a generation has just lit that fuse under the bond market, under the banking system, and under the prices of gold and silver in a way most people are not prepared for. This is not about whether we get a quarter-point cut in June or a hike in September. This is about something much simpler and much more brutal. The people steering the ship have finally admitted they don't agree on where the rocks are. When that happens, the rocks win. Let's start with the number nobody in Washington wants to say out loud with a straight face. $38 trillion. That's the US national debt, roughly, by the time you watch this. Not the promise, not the projection. The actual stack of IOUs already printed, already auctioned, already owed. At the current level of interest rates, servicing that mountain is costing over $1 trillion a year in interest alone. Interest, not principal, not new programs, just the finance charge on the past. Now layer on top of that what just happened inside the Fed. For more than a decade after 2008, monetary policy was a one-way bet. Zero rates, quantitative easing, whatever it takes. But the basic story was simple. Cut, print, support, repeat. That era is over. And the people who built their entire careers in that environment are now staring at something they've never had to manage. High debt, high rates, sticky inflation, and rising political pressure all at the same time. Some of them look at that combination and say, we have to hold the line, or inflation comes roaring back. Others look at the same combination and say, if we hold the line, the Treasury can't fund itself and the economy breaks. Those aren't academic disagreements, those are mutually exclusive realities. If you let rates stay higher for longer with this much debt, the math devours the budget. If you cut aggressively into sticky prices in a tight labor market, you sacrifice the currency's credibility. Pick your poison. That is why the dissent matters. Not because a few regional Fed presidents grumbled, but because the illusion of a single unified plan is shattered. Investors are not stupid. They just watch the one institution that is supposed to project certainty accidentally broadcast confusion. And in a world built entirely on confidence, confusion is the first crack. For 40 years, the global system has relied on one assumption. US Treasuries are the bedrock, the risk-free asset. Pensions, insurers, foreign central banks, they all stack Treasuries because those bonds are supposed to do one job, be boring. Except they aren't boring anymore. When the Fed is openly split, the path vanishes. Every buyer of long-term debt suddenly has to ask a question they hate asking. What if they're wrong? If you're sitting on a portfolio of 30-year promises in that environment, you are not calm. You are calculating. If you don't trust the traffic cop, you look for the nearest exit. Historically, there have been 3 classic exits. Move out on the risk curve, move sideways into foreign currencies, or move off the curve entirely. Gold and silver do not read Fed minutes. They don't vote at FOMC meetings. They don't need a majority to hold a level. Let's be brutally honest about what the dollar actually is right now. It is a claim on a government adding trillions in new obligations every year. Reserve currencies die slowly, then suddenly. Every time the Fed reveals another layer of internal conflict, we move closer to that suddenly. Every time Congress punts another fiscal decision, every time a rating agency whispers about another downgrade, a few more people quietly ask themselves a forbidden question. What if this doesn't get fixed? Not, what if we have a recession? Not, what if stocks go down 20%? What if the money itself is the problem? When that question spreads, even at the margins, something very specific happens. The role of gold and silver starts to shift from interesting trade to necessary insurance. This is where the divided Fed matters more than any single rate move. In a world where the central bank speaks with one voice, gold is optional. In a world where that voice cracks, gold and silver are no longer a hedge against inflation alone. They become a hedge against institutional uncertainty. Let me show you how that uncertainty turns into actual capital flows. Start with the simplest player, the foreign central bank. You're sitting in Asia, the Middle East, or Latin America. Your reserves are stuffed with treasuries because that's what everyone has done for half a century. You watch US politics, you watch the debt ceiling charades, you watch the Fed wobble between higher for longer and data dependent, and we don't really agree. You do something much quieter. You trim your plan to treasury purchases at the margin. You allocate a little more to gold. You sign one more bilateral trade deal that settles in your own currency. You ask your staff for another report on bullion storage capacity. None of those moves crash the system. None of them dominate a headline. But together, over time, they change the flow. Now zoom in to the institutional investor in New York or London. They are not stupid either. They know that if the Fed is divided, the range of possible outcomes widens. They know that wide ranges and high leverage make a bad mix. They do the only rational thing, they hedge. That hedge looks boring on a spreadsheet. Slightly more exposure to real assets, slightly less faith in duration, slightly bigger allocations to things that don't rely on policy. But in aggregate, it starts to show up in the one place most people never look, the slow, relentless bid under monetary metals. The fuse is not the price action. The fuse is the psychology underneath it. If you believe the people in charge can steer through this, you stay all in on paper. If you believe they're guessing, you start stacking things that don't need them. Here is where silver separates from gold. Gold is the vote of no confidence in the system. Silver is where macro stress collides with the real economy. Silver is industrial. It sits inside solar panels, EVs, data centers, medicine, electronics, defense systems. It is a raw input into the future. Gold can be sidelined in a tech boom narrative. Silver cannot. If they manage a growth push with massive infrastructure, silver benefits as an industrial necessity. Stable, predictable outcomes are becoming the exception, not the rule. Extremes, both in policy and in price, are becoming more likely. The Fed's division feeds the underlying cause, a slow, grinding loss of faith that these people can run infinite deficits and keep inflation anchored. So what does that mean for you? It means the clock has started. Not to a Hollywood end of the dollar moment, but to a repricing of risk. The only rational response is to stop betting your entire future on their ability to agree later. In the second half of this video, we'll walk through the chain reaction step by step. The psychology traps, the media narratives, the fake all-clear signals, and the decisions you will be forced to make when the numbers on your screen and the reality in your wallet stop matching. Because if the most divided Fed in 30 years just lit the fuse under gold and silver, the last place you want to be is sitting right on the blast cap, holding nothing but paper, hoping that people who can't agree on a plan will somehow diffuse it in time. So let's walk through the chain reaction. Start with the bond market, because that's where the fuse actually touches something flammable. The United States government cannot function without someone buying its debt. That's not a theory, that's the plumbing. Every deficit, every new program, every old promise that has to be rolled over goes through one narrow doorway, the Treasury auction. For decades, that doorway has stayed open because three groups kept showing up: foreign central banks who needed dollars, domestic institutions who needed safe yield, and a central bank that was willing to quietly step in whenever demand wobbled. All three are now under pressure at the same time. Foreign buyers are slowly diversifying. They've watched sanctions be weaponized. They've watched reserves be frozen. They've watched the political circus around the debt ceiling. They've watched the Fed lurch from 0 to 5% in record time. They are not dumping treasuries in the street, but they are not blindly adding either. Domestic buyers are doing a different kind of math. They see a Fed that can't agree. They see inflation that may not be as transitory as promised. They see real yields that can turn negative again with one bad CPI print. They might still buy, but they demand more compensation for the risk that the policy path swings in a direction that destroys their purchasing power. And the central bank, the Fed that used to be able to just fix the auction by expanding its balance sheet, that's where the division becomes lethal, because the same people who worry about inflation coming back are the ones who hate the idea of going back to large-scale bond buying. The same people who worry about debt sustainability are the ones who know that without a buyer of last resort, yields can spike into levels that break the housing market, the banking system, and the government's own budget. In other words, the Fed has trapped itself between two bad choices: print to save the bond market and risk breaking the currency, or protect the currency and risk breaking the bond market. When they were unified, they could at least pretend there was a clever middle path. Now, with the division out in the open, the market is starting to price in something much uglier: the possibility that they end up doing both in sequence. First, they hold too tight for too long. Something breaks, yields spike, liquidity evaporates. Then they panic, swing the other way, and flood the system with new money to plug the hole they created. That's not a soft landing. That's a controlled crash followed by a fire hose. And gold and silver are not watching that from the sidelines. They are in the center of it. Think about what happens in the first phase. Yields rise, stocks wobble, credit spreads blow out, the narrative becomes tight money, policy mistake, recession risk. In that phase, a lot of investors sell anything that looks like a risk asset and hide in cash and short-term paper. You see volatility, you see headlines, you see people telling you that even gold is selling off as margin calls forced liquidation. This is the part where most people make a fatal mistake. They judge the long-term health of a monetary asset by what it does in the first phase of a liquidity crunch. They see a downtick and say, see, it doesn't work. They forget what comes next. Because the second phase is the response. The same policymakers who were arguing about whether to hold or cut suddenly agree on one thing. We cannot let the entire system implode. The politics shift overnight. Emergency meetings happen on weekends. Acronyms you have never heard of get rolled out on Sunday nights. New facilities appear. Balance sheets expand. Forward guidance flips from higher for longer to flexible and supportive. In plain English, they print. Maybe they don't call it that. Maybe they use clever language. Maybe they pretend it's temporary. But the effect is identical. More claims are created against a real economy that hasn't grown enough to justify them. That is the moment when monetary metals stop caring about short-term volatility and start repricing the policy regime itself. Gold looks at the new wave of promises and says, I've seen this movie before. Silver looks at the same wave and then looks at solar demand, EV mandates, defense spending, AI data centers, and says, and I have a second job now. That dual role is what most people are still missing. If this were just an inflation story, gold alone would be enough. But this is not just about inflation. This is about credibility, debt saturation, resource constraints, and a political system that is choosing confrontation and expansion over austerity. In that context, silver sits at the intersection of three uncontrollable forces. It is money when trust in paper erodes. It is a critical input when governments push electrification and digitization. And it is a relatively tiny market compared to the oceans of capital that need a home. You don't need everyone to wake up. You don't need a global panic. You don't need every pension fund to suddenly decide they love bullion. You just need a small percentage of the capital that currently believes in the old regime to decide it needs insurance. The math is brutal. If even a few percent of global bond and equity wealth tries to move into an asset class as small as the physical gold and silver markets, prices don't adjust gently. They gap. They overshoot. They behave in ways that look irrational to people who forgot the reason paper assets looked so calm. The only reason was that a small group of people in one building could keep pressing the same button. That button is now contested. The fuse has been lit, not because of one decision, but because the illusion that there is always a button, always a plan, always a backstop, is crumbling. So what does this look like for you practically over the next few years? It will not feel like a straight line. It will feel like whiplash. You will see weeks where gold and silver surge on some shock headline, and you will see days where they get sold off with everything else. You will see commentators on TV say, see, it's just a speculation, nothing has changed. You will see them pivot back and forth between hard landing and no landing, as if the entire future hinges on an employment report. Meanwhile, under that noise, three slow, grinding processes will be at work. First, the slow exit from long-duration paper. Not a stampede, a trickle. Foreign holdings inching down. Domestic portfolios reducing exposure at the margin. New issuance having to pay just a little more to get done. That's how a funding problem starts. Not with no buyers, but with more expensive buyers. Second, the steady accumulation of real assets by actors who don't care about the daily chart. Central banks adding to gold quietly. Sovereign wealth funds taking positions in miners, energy, infrastructure. Corporations securing supply chains for critical inputs, including silver, because they can't afford to run out. Third, the political normalization of crisis tools. What used to be unthinkable interventions become part of the standard playbook. Each of those processes on its own would be bullish for metals. All three together, in a world where the Fed is visibly divided on how to manage the fallout, are something else entirely. They are a structural repricing signal. And here's the most important psychological point. You're not going to get a clean, friendly, obvious, all clear before that repricing happens. There will not be a press conference where the chair stands up and says, we've lost control, we recommend you consider some bullion. There will not be a headline that says, today is the day gold and silver start their secular revaluation. Please position accordingly. What you will get instead are mixed messages. Officials saying the system is sound while they open new emergency facilities. Analysts saying this is just like 2011 while the debt is double what it was then. Commentators telling you gold already went up, you missed it. When in reality, all that has happened so far is a modest move. The job of that messaging is not to inform you. It's to keep the system as stable as possible while the insiders reposition. Your job is to decide whether you want to be part of that repositioning or whether you want to be the liquidity. It's starting does not mean everything ends tomorrow. It means the period where you could ignore monetary metals as a strategic asset is over. From here on, these metals are not a trade. They're a line item in your personal survival plan for a financial system. So what can you do, concretely? First, get honest about your exposure to paper promises. Not just bonds, but hidden ones. Pensions that only work if returns stay high, annuities that assume stable inflation, cash balances that silently bleed purchasing power. Second, decide what portion of your net worth you are willing to move into assets that do not rely on the Fed being right. Third, understand the difference between having exposure and having control. Owning a claim on gold is not the same as owning gold. In a world where policy is improvisation, counterparty risk is not an academic concept. It's a yes or no question. Fourth, prepare yourself mentally for volatility. If you expect a smooth ramp higher, you will get shaken out. Finally, zoom out. This isn't about catching the exact bottom or the exact top. It's about recognizing we have crossed a threshold. The last regime was defined by trust us. We can always fix it. The new regime is we're not sure, we disagree. In that kind of world, not owning any real money is itself a speculative bet on competence, on unity, on a miracle. That is what it means when we say the fuse under gold and silver has been lit. Not that an explosion happens tonight, but that the clock has started ticking. And for once, you know it before the smoke fills the room. Tell me in the comments what the split inside the Fed means to you. Does it change how you think about your savings? Whether you act or not, this new era has already begun. The only real question now is simple: who or what are you going to trust?